Randy Messer 3369 says, what happened to rallying after earnings? You preached it for weeks. What's your prediction now? Well, you came to the right place. This has been a little different. Okay, AMC typically rallies about 80% of the time after earnings. Now, one time we rallied into earnings, sold off after earnings, and that was last quarter. And then in November of 2021, you didn't get a rally at all. Not before earnings, not after earnings. You sold off after earnings. But every other time, you have made a low around earnings, whether slightly before or slightly after earnings, or up to 1 to 4 weeks after earnings. And then you have rallied subsequently the 4 to 8 weeks after earnings. So this is not like an instantaneous kind of thing, at least not all the time. Now, here in this video, I want to talk about that, because what we're seeing with AMC stock is AMC going down. Now, why is AMC going down? I think that is very important to give you guys the context of, is this a strong, high conviction short that shorts are putting on right now? Are they shorting AMC? Are they selling AMC? What's going on? Why is the stock falling? Well, it's very easy to see if you have the Ortex platform. I understand a lot of us do not want to pay $600, $700, $800 a year for this. So we're going to look at it and really break it down why AMC stock is falling. Now, on top of that, we're getting some news today that Democrats, Republicans, all of your important names, right? Biden, McConnell, Schumer, it's the new guy's name. I don't even know what the new guy's name. Doesn't matter. These players, they're meeting over this weekend to discuss the debt ceiling. This is the meeting that was supposed to take place yesterday. It got postponed for this weekend. Now, this is either going to be really good news or really bad news. A lot of people took this news as bullish initially. Is that the right take? I don't know. But it's going to make for a lot more volatility, because coming here over the next couple of weeks, there's the highest chance of seeing a default in a very long time. Back in 2011, when they made a deal like literally hours from a default, there was only roughly 1.3% chance of actually defaulting. Now, you got over 1.5% or 3.5% chance of actually defaulting. This is the highest it's been in a very long time. You are seeing credit default swaps, the instrument infamously from 2008, are spiking a lot. And that's where the probability of such a default, that's kind of where you get the probabilities from. But with that being said, what's going to happen with AMC stock over the next couple of weeks? JP Morgan's Jamie Dimon, longtime CEO, like 25, 30 years now. You call Jamie if you got a problem. And if Jamie can't fix it, that's a very bad problem. Well, he said you could expect troubles with contracts, collateral, and clearing houses. This is something that really has not gotten a lot of attention that I think it shall rightfully deserve by mainstream financial media. Because if stocks were to fall that much, you're going to get a real collateral crisis, and that is not even without a default. Over the next couple of weeks, stocks will start to price in a greater likelihood of seeing a default after really today, right? Next week and the week after that. That's going to lead you into June 1st. That's going to lead you into the X date. If we don't have a deal done, markets are going to freak out more and more. And like Jamie Dimon says, and I've said this in a couple of videos, but I want to be very clear on this, because this is what I was thinking as well as what JP Morgan is expecting. Nobody is going to concede, Democrats or Republicans, and raise the debt limit until there is a reason to do so. Until stocks start to sell off, and until the bond market starts to freak out and investors sell bonds and shoot interest rates up. Until those things happen, you're not going to get anyone really jumping to get this thing done. They're going to talk like they are. They're going to make it seem like they're making progress here or there, or that one side wants one thing that's holding this process up. It's all political at this point. But markets will start to react to it. So without a default, this collateral crisis can become a very real thing. And that's really my base case for what I expect to happen. I just don't think a new bull market starts with 10 stocks in the S&P 500 and with banks at lows. That's never happened before, right? So I don't think you're all free and clear for this bull market. And as you can see today, S&P 500 is down about 3/10 or 0.75%. The NASDAQ is down over 1%. The Dow's not doing so hot. The Russell's not doing so hot. The VIX is spiking. And this is just today. The next couple of weeks are going to be much, much worse. And I think that ultimately does help fuel this collateral crisis that I see happening in the very near term. Again, aligning, okay, brain, can you please brain today? Aligning with the typical pattern you get from AMC, which is a rally after earnings. Now, we need to talk about this as well. And it is the Michigan Consumer Sentiment Survey. I know a lot of people don't want to hear about data. Nobody cares about anything, right? But feeding into that collateral crisis, a big problem that we see happening right now is, number one, the economy is weakening. The jobs report that we got, it's actually the initial jobless claims for a week-by-week basis. On Wednesday, or Thursday, that was yesterday. We got initial jobless claims that jumped about 22,000 from the week before. Now, why this is such a leading indicator is because it's not 1 month delayed like the jobs report is. This is by week basis. So we started to see the first jump, real sizable jump in initial jobless claims really throughout this whole cycle so far. So that's a leading indicator. Maybe the labor market is starting to soften. But it's really inflation expectations. The Fed has said every single Fed meeting that inflation expectations remain well anchored, and that's essentially their biggest worry. That's the thing that keeps them up at night. Now, what we've seen with the 1-year inflation expectations was in April, they jumped to 4.6% from 3.6% in March. So that was a big outlier move right there. And some people, there's this saying, and I know you guys have heard it before. 1 month doesn't make a trend, but every trend starts with 1 month. So markets didn't care all too much last time this came out at 4.6%. We want to see what the next data point is, and then the next one. And we just got that next one, and it was 4.5%. So slightly down, but still a lot higher than 3.6% where we were at in March. More importantly than that is the 5 to 10 year inflation expectations. Same thing here. In March, you were at 2.9%. In April, you jumped to 3%. And in May, you have jumped to 3.2%. This is the highest 5 to 10 year inflation expectations have been throughout this whole entire cycle. So now you have 3 increases to the longer term inflation expectations. That is starting to look like a trend. And that's the problem. The Fed's going to have to keep rates higher for longer or go, push the economy into a worse spot to get these long-term inflation expectations down. And to be quite honest with you guys, I think the only way this is going to happen is if stocks fall. Take a look back here in September and October. That's where you hit the lowest inflation expectations throughout this whole entire cycle, which is right here, right? These are the same inflation expectations since midway of 2020. Higher than where they were before at about 2.6 to 2.2% pre-COVID, but this would be before the inflation actually happened, which was about 2.7%. And that was at the lows of this market, right? October, where things were real bad. So you're probably going to have to see stocks fall quite a bit based off the inflation expectations. And that's really the only way they're going to keep those inflation expectations down, is to have the markets fall and to go into a recession. It doesn't have to be a deep one. It doesn't have to be a depression, but you're going to need to see a lot more economic weakness before the Fed is comfortable cutting rates or anything crazy the markets are expecting right now. So this is bad, and this is what happened today, as well as the overall sentiment number came in at 57.7. You were expecting a 64% reading, way off expectations. But, I mean, who cares? Inflation expectations are more important. But the overall sentiment of consumers is also pretty bad. Now, the number one thing that I've seen commented on the inflation expectations is this: why are inflation expectations hitting the highest point since mid-2020 and the Fed has raised 525 basis points? Like, what is wrong here? Is inflation just being psychologically embedded in people's minds? That's what this is starting to show. So do not underestimate this. Even though you're not getting a huge reaction in the markets today, it could fuel into, again, the debt crisis concerns and a slowing economy. And now you add inflation expectations on top of it that are hitting the highest levels you have seen in 3 years. That's a problem, okay? And all of those things put together is not good. It's not good for shorts that are heavily reliant on their collateral holding value to remain in their AMC short positions. This might be why you've been seeing AMC fall as of recently. If we take a look at what's going on with AMC, we don't have any news. We don't have anything that's really moving the stock as far as news driven. This has all been in the options, okay? The options have been incredibly bearish and incredibly large over the last couple of days specifically. And we looked at that for yesterday. The options, just the puts at the $10 strike was well over 20% of the volume of yesterday. Well, today it's really no different. So you're seeing basically the $10 put is being attacked at this point. At the July 21st expiration, the May 19th expiration, and the June 16th expiration. You got a $500,000 trade right there. You got another $600,000 trade right there. You got a $4.6 million trade right there. 264,000, $500,000, another $2 million in trades, another 300,000, another 500,000, and another 100,000 put together right there. And if we were to add these up, let's try to do some quick math here, right? You got about 6,200 there, 7,200 there, plus 15. What you're looking at about 24,000. Just round with me. 24,000. Let's call it 26,000. Let's call this another 10,000. You're at 36,000. You call that just call it 37,000 to round up, and you call it another. Just call it 37,000. Rough estimate of the size or the total amount of options that have been bought at this $10 strike today. So you do 37,000. Go ahead and times that by 100. You're at 3.7 million shares that had to be short so far. And keep in mind, there's still some time left, a little bit of time left in the day today, of shares that had to be short today, sold short today by market makers solely because of options. The volume so far is 8 million. That means almost 50% of the volume today has been market makers shorting AMC because all of these hedge funds are targeting the $10 puts that are very deep in the money, that have like a 2% to break even. Market makers don't have a choice there. They have to go out and short stock. And if you guys are unaware of the dynamics of how this actually works, just bear with me here. Same example from last video. You shorted, and you're going to be the short, I'm going to be the market maker. You shorted 100 shares of AMC at $5 per share. Well, what does that actually mean, right? Or say you bought a put. I'm thinking puts. You bought a put at the $6 strike or $5 strike. Let's call it you break even at $5 just for simplicity here. Well, if I'm the market maker and I sold you that option, that means that I have to give you 100 shares of AMC at $5 per share. You could exercise that contract at any time. So if AMC falls to $3 per share, then I would have to buy 100 shares at $3 per share and sell them to you at, you know, 5 or whatever. Or you would have to get them at 5. I would have to buy them at 3, whatever. So they would lose money on that trade, right? Well, now, since I'm a market maker and I don't want to lose money on that trade, I'll go out and short before $5 per share. So that when you want your shares, I can give them to you and I make a little bit of money as the market maker, or at least break even on that trade. So as you see more and more puts coming through, it works just like a gamma squeeze to the upside, but to the downside. And that's what you've seen is a reverse gamma squeeze happen on AMC stock. And that's been happening. Now, it doesn't look to be that bullish of a trade because they're targeting a deep in the money put. It's not like they're targeting the $2 or $3 put. It's not like they're going for a big winner on this. They're just trying to suppress the stock. That's it. Like if like a high conviction trade would be like a $2 or $3 put on AMC, or a $4 put for that matter on AMC, or a $5 put, right? They're not. They're $10 puts. They're trying to give themselves a little bit of cushion here because they don't expect the stock to fall that much, or they would go out and buy some strikes that weren't so deep in the money. So it's not a high conviction trade. They're simply trying to suppress the stock. And that makes a lot of sense to me right at $6 per share, the level in which they are terrified of. That's where they go out and suppress the stock. And if we look at the charts here, AMC's holding the trend. As long as you don't break down from here and close under about 490, then you're still bullish. AMC would still be hitting higher lows. Now, if you drop down to this previous low and you drop under that, well, now you're hitting a new lower low. That would be an end of a trend. As of right now, the bullish trend is still fully intact. AMC stock is at $5.19 per share. The 200-day moving average, or the 100-day moving average, is at $5.21 per share. And the 50-day moving average is at $5.16 per share. So you're right in the middle of these moving averages, a little on the higher end. So if AMC can close above $5.21 per share, that's ultimately what you would want to see. That would be kind of the best thing here. But really, anything above 490, and you're still in a bullish uptrend, right? And even had some people talking about $9+ per share on AMC over the next couple of weeks. So long story short, I do still think this rally is intact. This is not out of the normal to see a sell-off days after earnings. Like, matter of fact, it usually happens where you sell off 2, 3, 4, 5 days, maybe a week or two after earnings. And then you start to rally from there. Pretty typical. Even back here. You sold off from March 2nd to the low of March 14th. And then you rallied from $8 per share to what? $21 per share. Very common to see this happen. So I still think the rally is fully intact, you know, over the course of the next couple of weeks. Now, if we take a look at the live short interest, about 25%, 129 million shares currently sold short. Cost to borrow average 204%. Cost to borrow max 356%. Cost to borrow minimum 115.35%. Cost to borrow fees from interactive brokers at about 98%, with about 400,000 shares currently available to be lent out. Now, that is going to do it for this video. We did cover a lot of ground, so hopefully you got a lot of questions answered as well in that whole speech. But that is pretty much going to do it. watch for any headlines on the debt ceiling this weekend. That's really, I believe, what's going to drive the markets coming next week. Now, if you guys want to come trade with me live in real time, link down below in the description of this video. Things are about to get volatile, and when they get volatile, you want to be in that group.